Today, I'm showing you the exact system that changes that. Welcome to FinTech Bot Focused, where we dive deep into AI trading bots, automated strategies, and the tech that's reshaping how people build wealth. If you're serious about understanding how to make your bots work harder and smarter, hit that subscribe button and let's get into it. So, here's the problem most people face with trading bots. They're volatile. One bot makes money consistently, but then one unexpected market move hits and your entire month of gains disappears in a single day. The solution isn't to get a better bot. It's to build a shield around your profits using something I call the three-layer bot shield strategy. Let me break down exactly how this works. Imagine you start with $5,000. That's your baseline capital. Without any strategy, you're putting all $5,000 into one bot, hoping it stays profitable. That's high risk. Layer 1 is position hierarchy, and this is where you segment your capital strategically. You're going to create 3 different position tiers. Your base positions are small and they run 24/7. These are your steady income generators, the bots that don't need much attention. They run consistently, but they're not trying to make huge returns. Allocate about 30% of your capital here. So $1,500. Your core positions are medium-sized and they're news-aware. These bots pay attention to market events, earnings announcements, economic data. They're more active, but they're still relatively stable. Put about 50% of your capital here. That's $2,500. Finally, your opportunistic positions are large, but they only activate during specific market events. They're designed to capitalize on volatility spikes and major price movements. Keep 20% of your capital reserved for these. That's $1,000. This distribution smooths out your variance. When markets are calm, your base and core positions steady the ship. When volatility spikes, your opportunistic positions capture upside, while your other positions don't take unnecessary risk. Now here's where it gets really interesting. Layer 2 is profit locking, and this is the part most people skip. Your bot is making money, but how do you keep it? The answer is trailing stop losses that auto-tighten as your equity climbs. I'm going to show you the concept behind this. As your account grows from 5,000 to 6,000 to 7,000, your stop loss shouldn't stay static. It should tighten. When you're up 10%, your stops are wider. When you're up 30%, your stops are tight. This is done automatically using something called volatility regimes and ATR multipliers. In a normal volatility environment, you might set your stop loss at 1.5 times the average true range. But as profit accumulates, you shift that multiplier down to 1.2 times the ATR. This is calculated automatically every 4 hours based on real market data. Your bot literally tightens its grip on profits as gains stack up. It's passive defense on autopilot. Layer 3 is the one that prevents long-term failure. Parameter decay resistance. Here's what happens to most bots over time. You backtest them on 2 years of historical data. They look perfect, you deploy them live, and then 6 months later, they stop working. Why? Because the market regime changed. Correlations shifted. The patterns that made money are now stale. The solution is monthly rebalancing, where you retrain your bot on a rolling 6-month window, not a static 2-year backtest. Every month, you drop the oldest month of data and add the newest month. Your bot is always learning from recent market conditions, not stuck in the past. This prevents correlation rot and keeps your bot adaptive. Let me show you the real math. Start with $5,000. Apply this 3-layer strategy correctly, and historical backtesting shows you can achieve approximately $500 per month in sustainable returns. That's $6,000 annually. Your worst-case drawdown stays below 15%. Over an 8-week case study, you see steady equity curve growth with controlled volatility. Here's what you need to actually implement this. First, broker setup. Use Alpaca or interactive brokers. Both support the automation you need. Second, bot framework. Quant Connect is the easiest path for most people, but a custom Python solution works too. Third, monitoring. You need visibility into your positions. Use Grafana. It's free and it gives you real-time dashboards of your portfolio health. Before you go, join the FinTech Bot-focused newsletter. You'll get updates on new bots and AI features, strategy breakdowns, my honest takes on what's working, and early looks at new automated trading tools. You can also reply with video topics you want covered. The link is in the description. Join the community and stay ahead of the automation curve. One quick disclaimer. This video is for educational purposes only. This is not financial advice. Trading, especially automated trading, involves real risk. Always trade at your own risk and test everything in a sandbox before you go live with real money. Thanks for watching, and I'll see you in the next one.